Okay. What am I going to do today? I'm going to tell you why you shouldn't be worried about Wall Street. I'm going to tell you why you should be investing. The question I always get, and I answer it in Friday's column that's coming up tomorrow. At your age, whatever age that may be, should you be in equities? Should you be in stocks? Equity, stock, same thing. And the answer is yes. Should you have your entire portfolio in equities? The answer is again, yes. And I will debate to my dying breath with anybody who does not believe that's the case. In the current environment and the environment looking forward in the next 3 to 5 years, and in this town we don't go beyond 5 years in our format. You see, you must have missed that sign that said, "Welcome to Sarasota, God's waiting room." Yeah. So, yeah, we really don't forecast past 5 years. Look, by the way, before I forget, I need to do two things. One, would my staff please stand up? Well, I have any staff? Oh, there. Behind you is my staff. I owe them a great, thank you. A great deal of gratitude. They put this thing together. I did the slides, but they did all the work. So I couldn't do it without them. And every year I forget to introduce them, so this year I did. Also, we're going to have a drawing for 5 copies of the Investor Dividend Achievers Handbook. That's $48 at student prices, $90 at retail. Those little red tickets you got that got you through the door, hold on to them because there's going to be a drawing. Yeah, I know. People are going, "Where's my ticket? Where's my ticket?" Well, if you can't find it, you can call Myrene and she'll get you a student priced copy. Okay, I have a lot of slides, about 100. So buckle your seatbelt. We're going to go through stuff in a big hurry. Now, Albert Einstein is one of my favorite individuals. I know he's passed away a few years ago. I'm well aware of that. But I carry a fountain pen, same model he used. So, and he said, you have to learn the rules of the game, but then, as many football coaches will probably tell you, you have to play better than anyone else. If you're going to win this game, that's what you have to do. So what are we going to discuss? We're going to talk about Wall Street, what you're facing. We're going to talk about the environment of Wall Street. We're going to talk about the investment process, how you go about determining what you want to invest in. And we're going to talk about some companies I think will do well. For the lawyers in the room, this speech is for entertainment purposes only. I am not trying to sell you anything. I'm not trying to buy anything. I'm not trying to sell you anything. I have nothing to sell. I'm not a stockbroker, God forbid. Any stockbrokers in the room, I apologize. You shouldn't even be here. I apologize in advance. No, I'm not a stockbroker. I have nothing to sell. This is an educational seminar. I don't do selling seminars. Never have, never will. If you need to talk to me about business, you can come to my office. We'll do it in private. Okay, what are you going to face going forward? Well, this picture appeared in the Herald Tribune. The resolution is not great, but okay. It says, what are you going to face going forward in 2019? You're going to face purveyors of doom. That's what you're going to face. Everybody's going to tell you the market's going to hell in a handbasket. You're going to lose all your money. Sell. Buy gold. Bury money in your backyard. There are people who actually do this. It's amazing to me. I know somebody who actually buries money in the backyard. It doesn't grow, folks. You can plant it all you want and water it, but it's not going to grow. We have a kangaroo market. This one slide I kept from last year because I really like it. You got a bear market, you got a bull market, but then you got the kangaroo market. And based on Washington, D.C., you're going to continue to have a kangaroo market. In addition to an environment of high volatility, you're going to have to accept that. Great policy uncertainty, yes, you're going to have to accept that too. We don't know from one day to the next what's going to come out of Washington. You can pick the part you want. I promise Barry there'll be no political comments. I lied. We got significant geopolitical tensions. All you got to do is pick up a paper, take your pick, or listen to the TV. An unconventional presidency. Yep. That's one way of looking at it very politely. But it's not the end of the world. No, the world's not coming to an end. The economy's not coming to an end. The United States is not coming to an end. Nothing's coming to an end. Except my life, if you don't like this talk. Okay, Wall Street environment. This is the investment world you're going to be living in. So, you can't read this. I'm going to read you the key parts. You can read this on your own. You got slower growth and tighter monetary policy. There's nothing wrong with the Federal Reserve. Interest rates are still historically low, but they're going to raise them up a little bit because the cost of doing business in the United States due to tariffs, due to higher wages, is going to raise the price level. And the Fed's going to raise interest rates to go right along with it. But we're still low. There's nothing to worry about at this point. You got weaker corporate earnings growth. Why? Because we had a tax program that was like pouring gasoline on a fire. You got a brief burst, and now things are going to calm down. I like, they didn't like Apple Computer. Why? Wall Street wanted $85 billion in revenue for the quarter. Apple did $83 billion. Oh, hoarders. $83 billion. Their countries don't have GDP that large. Johnson & Johnson, a fine company, we're going to cover it later. Their sales for the whole year are just going to go over $80 billion. Apple does $83 billion in a quarter. And you're selling the stock? Political challenges, yes, we have some political challenges, and they're going to be disagreements with trade policy and so on. You got to accept it. The environment, the world continues to use resources in an unsustainable way. Unsustainable. We're going to have to come to grips with that one day. And that day is not long in the future. And we have limited long-term return potential. You don't know. Long-term, as I said, effectively is now 5 years. 3 to 5 years. Now, this slide shows Goldman Sachs has lowered what they expect interest rates to be. The yellow line is what they thought they were going to be. This is a 10-year Treasury yield where they thought they were going to be, and the revised numbers, and you can see the white bars, they're all lower. They believe that the U.S. is going to have lower rates, that Canada, Germany, UK, Japan, they're all going to have lower rates. But you can see Japan's rates are they're practically non-existent to start with. So, yes, yields are going to be coming down. Market volatility can make older investors feel vulnerable. You're 83 years old, you have a portfolio, wake up in the morning, like on the 26th of December, or 24th of December actually, you took one look at that and you said, hey, what am I going to do? Nothing. That's what you're going to do. When the markets are erratic, you do nothing. You wait it out. You have to have a diversified portfolio. This is crucial. And cash is not the answer. You all forget many times that you have an inflationary problem in this country. Not much, but it's about 2.2, 2.3, depending who you want to talk to, 2.4%. So every year, your dollar has that much less purchasing power. So why would you want to keep cash? I mean, yes, you need it for short-term expense, I understand that. But I know people who keep $50, $100, $150,000 cash in a checking account. Well, that's costing you, and it's costing you dearly. It's costing you the money you could have made, and you're giving up 2.2, 2.4% purchasing power. My assistant Jose did a study. You buy a 10-year treasury. This is called a risk-free investment because Uncle Sam's going to pay you in 10 years your principal, and he's going to pay you your interest every 6 months. But after that 10 years, if you invested $10,000, you have $6,000 of purchasing power. Now, if you don't believe me, the prices go up. Drop by your local grocery store maybe once every 3 weeks or so and look at prices. See where you're at. Volatility. Volatility is not new. I've been in this market literally because my dad was in the business before me. I've been in this market I've been looking at it since, 10, 12, 14 years old? My father coached me for many years. It's always been a volatile market. Over the last 40 years, you can see the percentage. You can see the volatility over 40 years. That's what's in the blue line there. So it hasn't gone away. We've had some periods when it's gone up a little bit. You can look at the peaks. They're labeled, but it's always going to be here. Case for raising rates. Should we be raising interest rates? Stock market decline tells us more about the market volatility than it does about the health of the economy. The economy can easily absorb some higher interest rates. That's not a problem. I know somebody said that, in fact, 2 people have reiterated that the Federal Reserve was responsible for the market dropping and the economy going to hell. Everybody blames on the Federal Reserve. They raised interest rates, a point? Total? 25 basis points around? And you're worried about that? I got a mortgage that's under 4%. My first house was a 6% mortgage. And I won't tell you how many years ago that was. The market does not deserve some kind of Fed-dispensed doggy treat just for bouncing around like a demented yo-yo. Now I can make a case against raising rates. You can see the Fed funds rate, that's that blue line. If you can see it, it's barely above 0. This is the real time. This is real, that's after inflation. Now, the Fed funds rate, what's actually going to happen, that you got 2 lines there. You got the blue line, the black line. The blue line that's dotted, that's what the Fed's planning on doing. The black line, which is a lower line, that's what the expectation is by the market. Here's the problem, they diverge. Wall Street wants one thing, the Fed wants something else. Well, the Fed doesn't care about the stock market. The Fed cares about the 2 things it's responsible for: full employment and low inflation. That's it. That's what it's there for, that's what it does, and it manages the money supply to accomplish those 2 goals. That's all. It's fairly simple. Now, my only problem with the Fed is Bernanke and Yellen, they had academic backgrounds. I read their papers, I read what they published. I read Bernanke's books. I have them. Yellen was in Berkeley, which is in California, I think it's Berkeley. She had a number of papers she wrote. She understood the world of monetary theory. Unfortunately, Powell does not. He's a businessman. Now you say, well, we want a businessman running interest rates. I don't know. There's one thing you do not want, and I mean this sincerely, it has nothing to do with politics. The Fed must remain independent of any government branch. Okay? That includes the executive branch. You cannot have, and we do not have, in any modern economy, a central bank, in our case we call it the Federal Reserve, that is subject to political influence. That would be a gigantic, gigantic mistake. That's what you see in third world countries. The economy has some cracks going forward. One of the ones that's showing up first is factory production, factory gauge. What you see in front of you is an index of showing faltering factories, factory production. You can see the big drop on the right-hand side. This is potentially a problem. I say potentially because factory production only accounts for about 15% of our gross domestic product. But it's an important 15%. And it's one of the first things to show up when the economy might be slowing. And if you look at this particular graph, here's another one, slumping factories. This is another manufacturing gauge. You can see the red box on the right-hand side. The line shows expansion versus, yeah, good, you can read it. Yeah. If you think I can read this screen in front of me, you're crazy. So anyway, you can see the drop on the right-hand side. An indication that all is not totally well with the economy. It's not bad, we're not having a fire sale, but things are slowing down a little bit. And there's some reasons for it. Here's New York manufacturing, a little easier to see. Again, it's dropping. I don't care which index you use. One of them is an ISM, this is one in New York. The Fed's the first one. They all show the same thing. Factory orders are slipping. Job openings. This slide shows you job openings versus job hires. The number of people who are, the jobs available and the number of people available to fill them. No, that's not there. Yeah, versus job hires. We have a tremendous number of jobs available in the United States. There's a problem. We don't have people to fill them. For one of the first times in a while, we have many more employment opportunities than we have people. And there's some reasons for this. And I'll get into that in a moment. But just be aware that this is the difference between job openings and labor turnover. We have more job openings than we have people available. The red line is openings, and the green line shows you people available to fill them. And you can see openings are now exceeding the number of people available. And there's a reason for that. And there it is. Immigration. I'm not talking about people who pick tomatoes or strawberries. That's not the issue. The issue is people who come to this country, get a master's degree or PhD, in the sciences, the mathematics, the biology, the people we need to do research and development, the people we need to build faster and better computers. Guess what happens to these people when they get out of school? We kick them out of the country. Now I know from personal experience, Jose, who's my assistant portfolio manager, I picked him up out of University of Central Florida. He had a student visa. He's Portuguese. He had a student visa. That student visa was about to run out. Now, what would have happened to him if he had not been engaged, did not get married, and was able to get a green card? I would not have an assistant portfolio manager. I would have an empty desk. Now, tell me this makes sense. It doesn't. We used to be a lot more open on immigration, especially to people who are graduating with graduate degrees in, I hate to say it, in the sciences, which I include mathematics. Where are they going now? Who is welcoming them? Canada. And they're laughing all the way to the bank. F1 visas dropped from 644,000 in 2015 to 394 in 2017. It's almost a 50% drop. But however, 1 million foreign students contributed $39 billion to the economy between 2017 and 2018. It's a major contribution. They supported 455,000 jobs. Now Moody's Investor Service just downgraded higher education sector to negative. Oh, this is great for our country. 90% of universities, majority of graduate students are foreigners. And this is the last, and this is important, unlawful presence. Well, let me tell you what this means. If you're convicted of a violation while you have a student visa, you're banned for either 3 or 10 years from the country. Now, what's a criminal event? Changing a dormitory without notifying somebody. That can get you banned for 3 years. If the school does not file a piece of paper correctly and you do not know it, you're out of here for 3 years. Does this make any sense? We're not talking about criminals. We're talking about things like changing your dormitory. Come on, give me a break. Another interesting slide. I hope you can read part of it. I'll read it to you. I was interested to see how various events, news events, media coverage affect Wall Street. Now, if you study the slide, there's a number of various ways. You've got trade news, there's a number of things on there. What you will find is, I'll give you the synopsis. Wall Street is very subject to the media. And if you don't believe me, start in the morning and listen to some comments. The market will go up. Other comments will come out in the afternoon, or somebody will write something, particularly the Wall Street Journal, New York Times, Washington Post, and the market either goes up or down. But here's the problem. Here's the question for you. Other than if you're a trader, and good luck, does this affect your holdings? Does this affect what the company is doing? Does Church & Dwight make any more, any less kitty litter, or Arm & Hammer baking soda, or toothpaste because somebody in the White House says something, or somebody in Congress says something, or somebody publishes an article? No. But the stock market's going to go up and down like a yo-yo. Your kangaroo market. It doesn't make any sense. You don't want to buy or sell, you're just hang in there with what you have. If you're looking for something, you've got a stock you want to buy, you've got the price worked out you want to pay, it hits that price, go ahead and buy. Just don't be surprised if maybe it drops the next day, or maybe it goes up the next day. A corporation's performance is based on only one thing: what it puts out as its earnings, its revenue and earnings at the end of each year. It's your annual performance that drives share prices, period. Now, you may not believe me that life was that easy. So I want to show you something real quick. A few years ago, specifically, (1924), this book was written. It's called Common Stocks as Long-Term Investments by Edgar Lawrence Smith. Not a very big book. Fairly good sized print. Not hard to read. The language is a little bit different than we use today. But what did Mr. Smith come up with? He came up with a very simple theory of why share prices go up. Now I'm going to tell you what the theory is, and you're going to say, hey, this is too simple. No, it's not. A company makes $1, pays out 10 cents in dividend. What's to do with the 80 cents? It puts it into retained earnings. What's to do with the retained earnings? It invests in the corporation. It compounds. Remember, compounding, the most powerful force in the universe, according to Albert Einstein. The next year, instead of making $1, it makes $1.10. It pays out 10 cents in dividends. Where does the rest of the money go? It goes into retained earnings. As the retained earnings compound, the company becomes more valuable, the stock price goes up. Pretty simple theory. John Maynard Keynes read the book, said, hey, he wrote several papers on the subject. Investing is not that difficult. This is what it's all about. A company does two things that are important. It has organic growth, which means if it sold 10 widgets last year, it's got to sell 15 next year. That's organic growth. Or it buys its competitors or other companies. That's the two ways it grows. And that's the only two ways it grows. Buying back stock is financial engineering. Okay? It's like a stock split. You're not going to become any wealthier. That was a problem with the tax program. They said, when we bring money back to this country, we're going to invest it in superstructures, in our corporate structure. We're going to make more jobs. They lied. They did two things. They bought back stock, increased three things. Increased dividends, and increased the C-level pay. C-levels, CEO, CIO, CFO. Yeah, that's who made the money. I won't tell you that, what I did, I did a thing in the newspaper. 8 of the wealthiest people in the United States control 14% of the country's resources. Yes, indeed. So where do you all rank? We won't discuss it. So yes, the various media, they do affect share prices, but it's temporary. This carries on. This is, Barry, this is as much political as I'm going to get, so relax. This shows you, I know you can barely see it, but that's the best I could do in getting the graph. What the graph shows you is the S&P 500. It shows you the various ups and downs, and every place there's a major change. Trump said something. Hey, shoot me. I'm just a recorder, okay? I didn't make the statements, but that shows you comments he made and what happened on Wall Street. Now, my suggestion is ignore it, because it's not helping you. It's not going to hurt you unless you sell. And if once you take a loss, that's it. And if you sell and you got a profit, guess what happens? Who has got their hand out for 20% right there, April 15th? That's right. And he doesn't wait till April 16th unless you want to pay a penalty. I put this slide in because I want to show you what the S&P looks like. You see the red line right about here? For those of you who see it over here, market really dropped. Yeah, that's Christmas Eve, they call it, right? I'm Jewish, not my holiday. Don't worry about it. We have a Chinese dinner at the synagogue, so actually, this was Italian. Chinese was terrible last year. But it recovers, okay? The market goes down, the red's down, the green's up. This is a 65-day moving average. You want to do some technical analysis? Here's what you do. You look at one graph with two things. You got the stock market, you got the 200-day moving average, and say a 60-day or a 50-day moving average. Usually it's 50-day moving average. When the 50-day moving average is above the 200-day moving average, it's a good sign. When the 50-day moving average is below the 200-day moving average, it's not such a good sign. And by the way, it only works for the S&P 500, not individual stocks. I did a study on it. Worst December since 1931. That's what it was, folks. 2018, the worst December. The big line is 1931. Oops, Daisy. Sorry about that. What the hell? I'll get there, don't worry. I'm not sure when I'm going to get there, but we covered that already.
Go the other way.
No, I want to go this way. Okay. No, you're right. I want to go the other way. Hey, look, I deal with investments. I don't deal with electronics, okay? So you get to see this stuff twice. There we go. It's got 6-day moving average. This is 1931, 2018 was next. But this is only 1 day. Okay? Yes. December, I'm sorry, it was December, okay? It was one month, December. And 2018 was a disaster in December. No argument. I won't disagree for a moment. However, it barely cracks the top 40. If you look down to 2018, with 38th on the list for top percentage movers. It was temporary. I know it ruins your Christmas, it ruins your holiday. Well, can't be helped. These things happen. But it did not indicate, it had nothing to do with how good a company was doing or not doing. Okay? So, I know it disturbs you, I know it gives you heartburn, I know you're thinking, hey, boy, I'm retired, I got X number of dollars, you gotta last me. I can't put up with this. You've got to put up with it because there is no other animal available. I told you cash is no good. We won't discuss bonds because bonds, they have no cost of living adjustment. You don't participate in corporate growth, and inflation will eat you alive. So that's not a way to go. So you have to go into equities. But I'm going to show you in a couple minutes the correct way of doing it, in my opinion. Of course. Economic cycles. We have economic cycles. Now the length of the current, what we call boom cycle, that's the yellow line. It's not the longest we've had, but it's getting up there. But if somebody please explain something to me. The economy does well. The stock market does well. Then why do people keep telling me it's got to come down? Where is it carved in stone that what goes up must come down, other than throwing a rock in the sky? Yeah, I understand gravity, but gravity doesn't apply here. People keep telling me, well, the market's up, it's got to come down. Please explain to me why this must happen. There is one thing and one thing only that will bring the stock market down, and that's higher interest rates. Because higher interest rates will choke off an expanding economy. It expands too fast for the Federal Reserve, whatever that number might be, and the interest rates will cut it down. It's like choking off a fire or a flame on a stove. You reduce the amount of gas, the flame goes down. Now, that means corporate profits go down. Corporate profits go down, stock prices are going to go down. I guarantee you. Corporate profits increase, stock market goes up. As a general rule, not every company, every company is a little bit different, but as a general rule, share prices go up when earnings go up. And earnings go up when the economy is doing well. Companies are making more money, building more plants, hiring more people. Things chug along pretty nicely. And they've been doing that for quite some time. Yes, you can choke it off. It takes a while, but it can happen. But it'll happen if you start raising interest rates because inflation is getting too high. And inflation right now is not getting too high, but the increased wages, because there's less labor available, you have to buy labor at a higher price, and those tariffs are adding to the cost of production. And somebody gave me an example. They went to buy a product they've been buying, and it was an industrial product, and the price was like $60,000, $70,000 higher than expected due to tariffs. Well, guess what? Their profit margin just went out the window. Now they got a contract with their client, their customer. They can't back out of it. They don't have a inflationary clause in the contract, though more and more companies are doing it. They have to now. But As prices continue to go up, the Fed says, hey, cannot have that. We're going to raise interest rates, get into a vicious circle. We don't want to go there. Those tariffs have to go, okay? Any economic student worth his salt who's had one class will tell you that one, nobody wins a trade war, and two, tariffs only do one thing. They end up raising the price level. That's it. No one wins. It's a very foolish policy. But it's there. Impact of a $50 barrel of oil, it will impact Russia. This is what's going to happen in 2020. You can see the U.S. impact, which is right, oopsie daisy, here we go again. No, other way, yeah, I got it. Yeah, I got it, here we go. I hate this thing. I try to use a laser and I hit the button. So anyway, we're right about in here. Russia's really going to get hurt. When they get hurt, what happens? They get mean. They're going to tell you, we got this missile, we're going to blow up the water, and it's going to flood your cities, and you can kiss goodbye New York. That's basically what they said. You believe it? They might actually have something along those lines. They want to create a nuclear explosion under the ocean, and that will create a tsunami wave that will wipe out the coastline. What do you think we're going to do? Sit around and say thank you? No, we'll blow them off the face of the earth too. And nobody wins. It's like tariffs, nobody wins. Anyhow, oil, we do not invest in. I do not recommend you invest in, but it's up to you, do what you wish. Any sort of oil company, energy company, we're not in that area. We have not been for three and a half years. Nor do I expect to go into it in the near future. Because we are floating in oil. We used to be beholden to the Arabs. And boy, were we beholden to them. And they squeezed us tight. Well, shoes on the other foot now. We're a very large supplier of oil. We export it. Hey, oil prices will stay around $50, $60 a barrel for some time. And at that rate, Iran, Russia, Venezuela, those three come to mind, they need about $100 to $120 a barrel to keep their economies afloat. And they ain't getting it. And it's a problem. Real problem for Russia. But Russia's not our main adversary. That's not where you have to worry. The adversary is China. They're much smarter than the Russians. They are some smart people over there. And they know a lot about electronics. And I don't know if you read the articles, some of you may know what a printed circuit board is in every computer. These little suckers, they took a little chip about the size of a grain of rice and put it between the layers of the board. And who do you think bought all their products that had this thing in it? Yes, we did. Along with every other country. That's why this little issue we're having in Canada with this young lady who doesn't want to be extradited because she knows what's going to happen if she does. Look, we've been ripped off by China for so many years, it's ridiculous. But, as I use an example with my students when I teach, I said, look, one morning I got dressed. As I was getting dressed, I looked at all my clothes. Every piece of clothing had made in China on it. Now, if we didn't buy Chinese, I'll be going to work in a barrel. Non-farm employment. Employment has gone way beyond the textbook full employment case. Okay? We should say if you hit 4%, boy, you're at full employment and you're looking for a rise in inflation because the economy can't stand it. Well, we've gone way beyond that. The difficulty is we now don't have enough workers. Now we're going to start bidding up wages, and that could get us into trouble. Inflation, I've mentioned inflation remains low. Inflation right now is not a problem. But it could be. It could become a problem. And then the Fed will take appropriate action. Now, everybody says to me, Lauren, What's going to happen in the future? Like I'm supposed to know, okay? How am I supposed to know? I can tell you this much. Right now, 2019, in my opinion, will be a pretty good year. Will we do as well as we did in 2018? No. Well, we didn't do that well in 2018, actually. The market didn't do that well. We'll do a lot better in 2019. It's 2020 you have to start worrying about. 2020, right now, the consensus is about a 67% probability of a recession. Mild recession, deep recession, I can't tell you, I don't know. I do know that when we get past this year, I showed you the cracks coming in the factories. Prices are rising somewhat. We don't have enough people to fill jobs, going to push up wages. The economy is going to start to slow. And the Fed's probably, because of the increased wages, increased cost of production through tariffs, which really threw the Fed for a loop, going to raise rates. So in 2020, we could have a recession. It's not a mandatory. It may not happen, but be prepared. Now, what are you going to do? Nothing. Nothing. Because you do not have any choice. What are you going to do? If you sell, you're going to pay 20% in your profits to Uncle Sam. If you have a loss and you sell, you've locked in your loss. You will have to accept a drop in the price of your portfolio. Now, but Lauren, I want to do a hedge. I want to do something that's going to prevent this. Well, as soon as you figure what it is, you come and tell me, we'll both do it. Jose and I have spent hours trying to decide what can we do to protect a client's portfolio. Now, we have 610 to protect. We can only come up with one thing. We would move into companies like, and I just give you an example, Procter & Gamble, that have weathered every kind of economic storm there ever was. Keep on doing projects because I don't care what happens, you're still going to buy detergent. You're still going to wash your clothes. You're still going to buy soap. You're still going to buy toothpaste, and on and on and on. But there's some big corporations like 3M, and by the way, in every day of your life you come across one or more 3M products. Procter & Gamble, Smuckers. You going to stop eating peanut butter? Not in my lifetime. And jelly? Diane's got shopping orders. I just threw away one like a brand new thing of Jif at Smuckers. No, that would be the only place where you could take a little bit of hiding. And I don't necessarily recommend that because if you sell profits, you got to remember, if you take a profit, you just kiss off 20% of your money. It's gone. And if you have a loss, you lock it in. There's no escaping it. So what this graph shows you is we're fine through 2000 up to about 2019. Pushing the right button this time. This is the projection part right over here. For those of you on the TV screens, the dotted part, that's projection. This shows you the probability of a recession. When you get out past 2020, it gets really iffy and it's not looking too good. Doesn't mean it's going to have to happen, but there's a potential for it. Here's some forecasts. I've done a forecast. I said that the GDP, and I put this in the paper, I put it on television, I told my students, I'll tell you too, I'm projecting that the economy will grow by 2.6% in 2019. I've gone on record, so there's no backing off. See, one of the things about being a newspaper columnist, you can tell people you said something, but you go back and check it. Yeah. They can hold the old proverbial toes to the fire. If you go back and you Google my name, There's roughly 5,300 columns out there. Please be my guest and read them all. That'll take you a while. No, I believe the economy will grow by 2.6%. So, but I went to Bloomberg. We have a Bloomberg system. We've got a couple of them. So I thought you might like to see what they're forecasting is 3.6% unemployment. Headline CPI, that's before the core, 2.3%. Core, 2.2. Fed funds rate, 2.5%. 2019 doesn't do 2.4% growth. By the way, in 2019, they're looking for 2.4%. I'm looking for 2.6. They're looking for 3.4 unemployment. 2020, they're looking for 2.1% economic growth. 3.4% unemployment unchanged. Headline CPI, 2.2. Core CPI, 2.2. Fed funds rate, 3.25. The difference between the core and the headline price levels is that one subtracts off food and energy. See, these aren't important, so we take those off. You can't forecast food prices, you can't forecast energy prices, so we give you both numbers. And the Fed doesn't even use the CPI, they use a different methodology, but they're fairly close. Depends on which direction you come from looking at it. Here's 3 more forecasts. These came from 3 of the largest banks in the United States. Their GDP growth for 2019, one had 3%, one had, I see here, they didn't do the GDP. The other one didn't do a GDP either, so only one did a GDP. But what's key is I'm looking for 28 to 2,900 on the S&P 500. I've also written that. And the numbers here are, one's got 3,100, good luck, 2,750, and 2,900. They're all over the board. Now, why are they all over the board? Because nobody knows. It's a guess. Yes, we have data. I've got reams of data, and I have all kinds of models, and I try to make a projection, and I try to throw some common sense in, which means throw out the numbers and just use the common sense. I'm looking for 2.6% GDP growth and 2,900 in the S&P 500. So if you want to hang me at the end of the year, that's my numbers. We'll see how close I come. As I said, I published it. It's a matter of record. You Google it, you get it. So, why invest on Wall Street and why equities? We've gone through all kinds of economic data. What I tried to show you is the economy is growing, the economy is doing relatively well, but there's cracks. It's like ice skating in the springtime. There's a few cracks in the ice. If you're not careful, guess what happens? You go for a dip. Same thing with the economy. So, number S&P 500 market declines in 30 years. We've had 10 market declines greater than 5% but less than 10%. One in the past 10 years, and that happened in 2018. The market's not going to vacuum up your dollars. Here's daily market declines. The largest S&P 500 market declines. This does not count this year. You can see there's none above 10%. Same thing applies for the Dow. And by the way, don't use a Dow industrial average to gauge anything. It's 30 companies. There's a problem with the S&P 500 too. You see, there's about a dozen companies, maybe a little less than that, 8 to 12 companies on the S&P 500 that account for 18% of the move of the S&P 500. Because you've got Apple and Google, all the FANGs. So what happens to the smaller companies? They're not playing much of an active role. So when the S&P jumps up or jumps down, those companies by themselves could cause it to happen. Meanwhile, little old Church and Dwight just goes chugging along, did 30% this year, in 2018. 30% return. Not bad. We're making Arm & Hammer baking soda. Sexy product, isn't it? Durations of post-war expansion, this is what I was telling you. Why is everybody telling me the thing's going to drop? No, it doesn't have to drop. We've had 3 expansions longer than the one we have right now. The red line is the current one. Hedge funds. Hedge funds. Client comes to me. He says, I invested in some hedge funds, but the money's going to come back. It's going to come back. How much did you invest? $600,000 of his wife's money. Because he didn't have something to, you know what. He said, Lauren, can you help me out? I said, sure I can. I'll put you in our Core 40 portfolio. Spends 2 years with me. Compounded growth rate, 14.9%. A lot higher than 0, isn't it? I go to Portugal to Jose's wedding. I promised him I'd be there. Diane and I fly over. I get a call from my office. Clients left us. What? Why? Turns out, you see that the hedge fund he went with, that was family and friends. Well, now he's got family and friends. The son of a friend of his is opening a brokerage house in Philadelphia. So he's transferring the money over there. I said, you don't learn your lesson. Family and friends cost you $600,000 of your wife's money, and now you're going to take the rest of it, and you're going to put it with somebody who you don't know. I mean, you know the father, in a brokerage house that's commission-based, and they're going to sell you mutual funds and annuities and bond funds, and you're going to lose the rest of your wife's money. I only hope one day she wakes up and looks at the statements. I couldn't believe it. You see, unfortunately, I can make money from most anybody on Wall Street. That's not difficult. My dad taught me how to do that. The lessons got bitter sometimes, but he taught me how to do it. That's not where I spend most of my time. I spend most of my time protecting clients from themselves. Because they come to me with grandiose ideas, things they want to do, and I point out to them it's not feasible. You can't get there from here. Well, my neighbor told me about this hot stock. Well, tell your neighbor to buy it. I can show you how to make money, but if you want to complicate the process, it's like, watching a plumber work. He charges extra if you tell him what to do. Hedge funds, down almost 6% this year on average. Growth diversification, this shows you what is going to go ahead in 2019. In this case, we have GDP growth, you've got personal consumption and so on. It points out that, yes, the market is going to be favorable through 2019. Now, we've had some sell-offs. People think about jumping out a window, but it's a one-story window. All they're going to do is get hurt in the bushes. We've had sell-offs before. How do I explain to you all? See this graph? Both sides can see it. The yellow line is the S&P 500, basically. You see the red things? That's the drops. But what is that line doing? It's going this way, isn't it? About 30, 40 degrees. This starts at 1940. Then, yeah, I can take a small piece of that graph where those leg sections are, and I can say, look how the market dropped. Sure it did. But look where it went overall. As long as the economy grows, the United States becomes more prosperous, the companies in the United States will prosper, and so will your stock portfolio. And it's as simple as that. Here since 1900. Shows you all the bad things that happened since 1900. The market's still going up. What can I tell you? It's S&P 500. Yeah, we had some little difficulty, little about right here. Oops, daisy, I did it again. Did it again. There we go. That's the button. See, now, okay, no problem there, but look, we recovered here. Look at this. Sure, we had some dips. No problem, okay? But this, look at the dates on this thing. And it's a log graph, by the way, which means the things are the same distance apart, regardless of what the numbers are, same percentages. So it's a very good graph. This shows you what the S&P has done. And don't you wish you started over here, huh? World War I? I would have liked to, but 1913, I don't think I was alive then. 1918 was here. I didn't come to this earth until about there, and the market dropped. Well, that time. So, I mean, yes. Yes, 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 yes. Here's a Ford PE. Yeah. You know, depending on what time frame you use, I mean, you can do anything you want. Here is, you know, shows you up 1.6, down 0.49, up 101, down 57, up 271. You're still better off having been in the market because this is where you end up. You say, well, suppose I came here, all right? So you got 57% drop, then you got 271% gain. Where's it bad? Can you live through that? Of course you can. Of course you can. Besides, that was 08. And that was a little bit of a nasty time. As far as I'm concerned, when I do analysis, I start at 2008, okay? So I start right about here. And this is what I look at. Because 2008, that was a watershed event. And the Great Recession was brought on by Wall Street. No one else was responsible. Wall Street was responsible. They and the rating agencies. I won't go into it. If you want to, read Ben Bernanke's most recent books. He covers it hour by hour. We let Wall Street nail us, and they did. Because, as was said in that movie Wall Street, greed. Greed is good. Well, it's not quite so good, okay? But Wall Street is driven by greed. And I got news for you, every one of you. When you come to me, if you come to me, or those of you who are clients, if you come to me and you want to invest, why are you doing it? Because you want money that you don't have to work for to buy the better things in life. That's another definition of greed. Hey, tell me it's not true. Why do you think people line up to buy lottery tickets? Gets to be $1 billion. Your line goes around the block. All right. These are returns by style. You can't read it. I'm not going to go through it. If you read it if you pick up the slides, it shows you how all the returns, all the styles worked out last year. Dividends. The green is the dividend. The black. Dividends are critical to your portfolio. They're cash in your pocket. They're not something on the counting sheet. This is why we preach dividends, dividends, and more dividends. And we only invest in companies that have been raising dividends for at least 10 consecutive years. Period. You do not go into our portfolio unless you can meet that one requirement. That's the first requirement. That's the first hurdle you got to meet. If you can't meet that, you never even get considered. And I recommend you do the same. For the record, there are 269 companies as of this point that have been raising dividends for 10 or more years. That's it. 11,500 companies trading. We're only interested to start with 269. Real quick shortcut, when we get halfway through our analysis, we're down to about 100. When we get done, we have 70 companies. We invest in 40. That's our universe. That's it. 40 companies, 70 possibilities, I have 11,000. Which, if I may say so, is why we're successful. Here's the probability of the recovery ending within a month. You can see it's less than 5%. Conclusion. Empirical evidence indicates expansions during the last 70 years do not become progressively more fragile with age. Evidence supports the view that the current recovery is not living on borrowed time, and expansions like Peter Pan endure but never seem to grow old. So, is this the time to invest? I love that statue. People rubbed all the finishing off the nose. People can't walk by without going like this. It's a statue, folks. It's not a god. Yes, but only with certain understanding and constraints. Here we go. Patience is a virtue. While its volatility is not back, it never left. If you lose sleep over a dip in the market or even a 10% correction, bone up on patience. No one in the history of the stock market has ever been able to accurately and consistently time corrections. I forget who said it, but he said more money was lost in the predicted corrections than was ever lost in any corrections. You cannot predict the stock market. If anybody tells me he can or she can, they're lying. Point blank. You can forecast corporate performance, but not the market. It's a random event. Period. I've done it. I've spent hours trying to figure out if you could do it. You can't. I know you can't. Wall Street moves up 2 steps forward and 1 step back. What do you do when it steps back? You don't panic or sell, you buy. Don't fear higher valuations. Underweighting equities based exclusively on high valuations has underperformed the strategy of remaining invested. There are enough academic papers to prove this. This guy's book teaches you that. Okay, this is my favorite slide. I did it last year. I'll do it again this year. Wall Street Journal went out and looked at the top 25% of the mutual funds that are available to the public. It was a total of 2,862 mutual funds. By 2014, they started 2010, by 2014, only 2 remained in the top 25%. 1 year later, none. And you're telling me it's the way to invest? You're giving your money to somebody you don't know, will never meet, doesn't know you, doesn't know what your goals are. They're buying stuff that they don't tell you about and they won't tell you about for 90 days. And you happily write them a check. Why? Because some broker told you, hey, it's a good deal. Yeah, good deal for him, bad deal for you. If they had flipped coins, roughly 3 would have been in the top quartile after 5 consecutive years. And you know that's Burton Mako, very famous statement, a blindfolded monkey throwing darts at newspapers' financial pages could select the portfolio as well as the experts. Okay, so you're going to invest. Okay, you believe me, you're going to invest. Here's 9 rules to follow. 1, discipline. Be risk adverse. Money management matters. Rely on objective indicators. Beware of crowds and extremes. Be flexible. Don't fight the Fed. Don't fight the tape. And use history as a guide. Don't use it as a predictor. Use it as a guide. Every year I come up with 12 stocks. This was 2018's list. These were published January 2nd, 2018. And I looked at the results on December 31st, 2018. And guess what? They didn't do that well. I admit it. But I sure as hell beat the S&P 500. Produced a return of 4.09%. The total return on the S&P 500, 4.3% negative. But you can't buy the S&P 500 total return. You have to buy the SPDR. It returned a negative return of 4.56%. So we basically beat the S&P 500 by 50 basis points. The problem was it was negative. That's a minor detail. We still beat it. All right. These things happen, okay? It was not a great year. Okay, I'm going to improve upon it. Here's this year's list of 12. Now, I did a little check because it was released on January 2nd. How's it been doing? Upper left-hand corner. Between 102, January 2nd, January 22nd, list of 12 was up 6.85%. As the spider, 6.46. So we beat it by 39 basis points, that's 0.39%. 6.85%. We were trying to recoup that 3%, 4% we lost. Different stocks, but these are the ones for this year. I did you a favor. You probably can't read this, maybe you can. I talk about intrinsic value. We'll get a little definition of that in a minute. I gave you the intrinsic value of those 12 stocks. You don't have to calculate it even. So I gave it to you. Well, I'm not saying it's the end all be all, but it shows you that 1, 2, 3, 4, 5, 6 of those stocks out of 12 had intrinsic value above their share price, which means they have a very high probability of increasing in price. Trying to get closer to that intrinsic value, which hopefully will go up. The worst miss was 0.89, and that was Toro. And if Toro, if you've never heard of, I'm sorry, Intuitive Surgical only had 0.67, but there's a reason for that. They don't pay dividends, and Intuitive Surgical is a great company. They make the robotic surgery thing. What's it called? Da Vinci, yes, they make Da Vinci. Intuitive Surgical. These slides will be on my website. You can go back and look at this stuff all you want. And if you don't know Toro, you never lived up north. Or you never played golf, one of the two. Or both. Okay. Example, bullish playbook. Administration compromises on trade in the budget. Federal Reserve tempers its balance sheet reduction. Slowdown in U.S. growth is modest. China continues to ease. European growth recovers. UK deals with Brexit. Good luck. And corporate earnings up about 7%. I think most of these things will come through, which means that 2019 would be a pretty good year. But intrinsic value analysis, that's something what you have to know. This is critical. You have to understand that a company is worth a certain amount mathematically. I'm not going to go to all the details. You can look it up on my website, you can look it up on Google. Intrinsic value, there's 4 models, we list them on the website. We can give you 3 of the models. It tells you what a stock is worth mathematically, not what the market says it's worth. And you want the intrinsic value to always be above the share price. Then you have a better than 60% probability that you'll be successful with that stock. Good. Write that down, tattoo it on your forehead, look at it every morning. I recommend you use 3 models. This is what I teach my students. Free cash flow of the firm, discounted earnings, and a dividend discount model. Every analyst on the street uses a dividend discount model. But you know what's interesting? I was looking at the business section Monday. That square piece of paper they give you in the paper, square booklet. And there's some ads from some of my competitors. Guess what they're pushing this week? Dividend models. Dividend growth models. For the record, each one of these people has been in my office finding out what I did and maybe wanting to, maybe hook up with me. They lied. They weren't see what I was doing. Now they're all trying to copy it. Well, here's the problem. They're not analysts. Jose and I are stock analysts. We've worked, he's never worked on the street as an analyst. I have for many years. I was taught the business from an analyst perspective. Schwab has told me this. He says, you're the only firm in Sarasota that are actually analysts. You analyze companies. Yeah, that's what we do for a living. We analyze companies. That's how we select. You can run all the intrinsic value models you want, but how do you select the right companies? That's the key. Compounding. Remember, compounding is key. It's adding accumulated interest back to principal, so the interest is on the interest. This is what drives up share prices. CAGR. You must learn this term. You must. If I teach you nothing else, I want to teach you this. Compounded annual growth rate. It shows you how much your portfolio or a particular share of stock has increased over time through compounding. Okay? To say your stock portfolio is up 15% doesn't count. It might have been 15% over a total of 15 years. What you want to know is how much has it done each year to compound to get where it is now. Client walks in my office, I got a 15% return on my portfolio. I said, that's great. Can I see your numbers? Well, he said, I started here, now I'm here, and I got 15% return. I said, no, sir, you don't. You have a return of around 4.5%. No, I don't. I have a 15% return. No, sir. Here's the book. Here's the formula. You do not. I can help you get to where you want to get, but you're not there. Oh, yes, I am. I got 15% return. Gets up, slams the door, walks on my office, slams the door. Never came back. Jose went back and calculated exactly. It was 4.86%. I see roughly 15 to 20 people a week, of which half are prospects, a third are prospects. Jose will verify that we've only seen 2 instances in the past year of investors who came to us who had a compound annual growth rate of greater than 5% in their portfolio. 2. I know you're going to go home and grab your portfolio and start doing some calculations, aren't you? I got to see where I am. 2. It's the year-over-year growth rate over a specified time period. Now, don't get scared. It's the nth root of the percentage growth rate where n's the number of years. There's the formula, okay? That's not multiplication, that's an exponent. Every single calculator that costs $10 or more can do this calculation. It's no big deal. You take the ending value divided by the beginning value, and then take it to an exponent of 1 over the number of years, and subtract 1. That'll tell you what your CAGR is. Every single Investing 101, Economics 101 textbook, and Google and everybody else in the world has this formula. So take it home and look at your portfolio and tell me how you did, or tell yourself how you did. Don't tell me, I don't care. Valuation, discounted cash flow, foundation of most approaches to valuation, based on the concept of present value. I'm going to give you a quick example of present value and move on. The lottery says the jackpot is $500 million. Cash value is $200 million. These are random numbers, folks. If you take the $200 million and you put it to 5-year treasury rate for 30 years, you get the jackpot. The present value is $200 million. You have a corporation that's paying dividends, and it's raising dividends by, let's say, 7% a year. And you take that out to infinity. What is that stream of cash worth today? That's the intrinsic value on the dividend discount model. And that number should be 10 to 15% above the share price. Period. Not that difficult. I'll show you an example. I'll give you a little Excel program that'll calculate it for you. I'll give it to you. Come on my website, help yourself. Present value, amount today that's equivalent to a future payment or series of payments that's been discounted by an appropriate interest rate. What's the appropriate interest rate? It's your return that you demand. We use 10%. You can use whatever you want. We try to shoot for a minimum 10% return, plus dividends. Present value, money has time value. Present value of promised future payments is worth less than the longer you have to wait to receive it. The difference depends on the time periods, the compounding, and interest rate or discount rate. It all comes down to how you invest, what you invest in, how do you hold on to your profits. Here's where your goal should be. Capital gain, 7 to 9%. Dividend yield, 2.5%. Total 9.5 to 11.5%. Lauren, can you do that? A good question. I asked myself that question. Our firm has been in business for 6.5 years. The reason's only been 6.5 years. As some of you know, I had prostate cancer way back 2002, sold my business, retired from the industry, and then decided I had to get back in the industry. That's why Wright International was only 6.5 years old. But I took clients who've been with us the first month we were open. And I looked at their portfolio from then to today. I wanted to see how they've done. Now, these clients, this one in particular, which I use for an example here, she takes out $6,000 a month. Started with about $860,000, takes out $6,000 a month. Occasionally a little bit more for taxes. She's worth $1.2 million today. Her compounded annual growth rate is around 10.2%. A little bit lower, it's about 9.5 right now because the market was down last year. But that's her compounded annual growth rate. She's got more money today than when she started, and she takes out $6,000 a month. Okay, that's cool. Yes, it can be done. Dividends, a minimum of 10 consecutive years of rising dividends. Intrinsic value, there's 4 models. Free cash flow to equities, free cash flow to the firm, discounted earnings, and a dividend discount model. There's 4 models you could use. We recommend 3 of them for individuals. Understand we have some very sophisticated computer equipment. We can do things pretty quickly. Okay. Identify dividend achievers. How are you going to do that? Well, I can tell you one way is really easy. I go get a copy of the Dividend Achievers Handbook. They list every company that's been raising dividends for at least 10 years. Comes out quarterly. It's a little expensive if you buy it retail. Costs you $90. Come and see me. I'm Jewish. You get wholesale. $48. Just don't tell the publisher. I'll pretend you're a student. Yeah, people do it. They put the name on the list a year in advance. Determining intrinsic value. I'll show you exactly how to do that in 2 minutes. Forecast the financial development an optimal portfolio of 10, 15 to 20 companies. It's not rocket science. Everybody in this room can do it if they want to. If you don't want to, well, here's some investment aids I'm giving you this evening. Dividend Achievers Handbook. I'm going to give away 5 copies tonight with those red tickets. Reading list, ValuePro.net, list of websites, understanding portfolio returns, and Excel worksheets. All these things you're going to get right now. I'll tell you where they are. Investment methodology. That is Dividend Achievers Handbook. The only reason I put this on was back in 2003. And before that, I was quoted in the back of the book. His quote is varied, but here's where I said. If I was stuck on a desert island, no computer, no internet, I could have one investment tool, what would it be? The Dividend Achievers Handbook. That's how important I think that one tool is. And bulk of my students buy it every quarter. I teach about 51, 54 adults every quarter for lifelong learning. I run 3 courses a year, Introductory Investment Analysis, Advanced Investment Analysis, Portfolio Management, 8 weeks each. And most of my students buy the book. I don't make them buy it. I don't make anything on it. All we do is pass it off. I mean, we pay shipping and tax. I think it's that important for people to have. Can't afford to give it away, but they sell me at a student price. Please don't tell anybody. They'll know I'm Jewish, so we don't. Here's an introductory reading list. These slides will be on the website. You can go get this. Here's 3 books I recommend you read. These are introductory books. Okay, some of you are more advanced. Here's an advanced reading list. A few more books. Some of these books are difficult to go through. I admit that. That's why I said advanced reading list. You know something about investing. This is on my website too. I mean, you can get this off. ValuePro.net. One of the key models is intrinsic value using free cash flow of the firm. You don't have to do any calculations. You go to ValuePro.net, type in a stock symbol, and up comes your intrinsic value. And that's difficult, isn't it? One small problem, the number's not accurate. Sorry about that. It's managed by grad students. But I have a solution for you. On my website, it's a little video. It takes about 3 minutes. It tells you exactly how to correct it. I use Apple as an example. Now here's a tip. You run ValuePro.net with a stock, intrinsic value comes out to be X. X is considerably higher, or 15% or more higher than the stock price. Go on. Okay, don't worry about correcting it. You're only going to make it better. So, all you're interested in knowing is it or is it not 10 to 15% above the share price? Doesn't make any difference how it gets there. Now you can go through, you look at the video, you can correct it, do whatever you want, no problem. Well, Lord, do you use this? No, we don't. Sorry about that. We use Bloomberg. I got to tell you a quick story. I don't know what time it is. Oops, ouch. Bear with me. When I hired Jose, he was an intern. Came to me and wanted a job. Said, you don't have to pay me. I said, good. You can be an intern for the summer. My wife said, you're going to pay him. I paid him. I made him and another guy do all the intrinsic value models of every company in the Dividend Achievers Handbook. It took them 2.5 months. Today, you know how long it takes us with Bloomberg? 15 minutes. Yeah. I brought a sample of the ones I recommended. I brought a sample with me of the intrinsic value. We have a fairly fancy program, and all we do is type in a stock symbol and all the data comes back because Bloomberg is a genius. You pay for the genius, though, believe me. This is what ValuePro looks like when you do it. You can see that it says intrinsic values up in the left-hand corner. There's numbers. You can change those numbers. There's a thing on my website that tells you how to correct it. Here's an Excel program. This will do both. There's one program in here for using earnings and one for dividends. You can have this spreadsheet. It's on my website. All I ask is that you use it at your own risk. Okay. People ask me, where do I go for information? All right. I made a list. 25 most important websites. They're hot linked. It's on my website. Click on it and you'll go there. These are what I consider to be the 25 most important websites to go to for investing. It's all yours. Help yourself. Companies likely to do well. I'll do this real quickly. Amazon. One of the best long-term stories out there. Doesn't pay dividends, can't be in the core 40. We had a 12-month target price of $1,430 in 2018. We raised that to $2,126 in 2019, and the current price when I did this on January 15th was $1,674. So we beat it all the way around. Microsoft, dividend yield 2.9%. 10% 2015 through 2018, the CAGR on it was 10% for those years, 3 years. 13% total return. You got the 2.9 dividend plus 10%. Intrinsic value 146 versus 92 in 2018. Current intrinsic value 125, current share price 105. 12-month target 125. Folks, I'm giving you this. Let me put it to you, for those of you who misunderstood what I said. The intrinsic value is higher than the share price. There's my estimated numbers. I've done all the work. Now, except unless you want me to buy the stock for you and put it in your portfolio and pay the commission. Church & Dwight. I love this company. I've been investing in it for more years than I can count. 2018 price of $49.78 versus a target of $55. Current price $67.38. 2019 target $74. Intrinsic value $82. 1.3% dividend yield. They've been raising dividends for, if I'm not mistaken, 14 years. Great company. That baking soda, you can use it. They use it to make cat litter now. Now I've got 9 cats. Cat litter is a very important product around my house. Not as important as hay, because I got 10 horses, but a very important product. Johnson & Johnson. Company has been unbelievably hammered of late. Because people say I use talcum powder, I got cancer. I only know a couple of things. One, when I was a baby, the best of my knowledge, my mother used Johnson & Johnson talcum powder on me. The best of my knowledge, I do not have lung cancer or any other kind of cancer. Thank God, unfortunately. Company's being sued. Let me show you something. First of all, let's look at their profile. $1 billion platform of products. They got 14 products that generate over $1 billion. $2 billion, they got 12 products. Listerine. That's one you all should know. I mean, they got a whole bunch of stuff. Because they have some tailwinds. I'm not going to go through them in headwinds because of time. But here's the liability cases. Let me tell you something. The thing for talcum powder is only 11,700 cases. Pelvic meshes have 37,400 cases against them. Talcum powder is down the list. They got 3 above it. They got a total of 102,600 lawsuits against them. Let me tell you something else about the company. There are only 2 companies in the United States that have a AAA credit rating. That's one of them. The other is Apple. Mr. $83 billion in revenue for the quarter. And you sell the stock. There's a stock price. You can see it drop down. Am I still buying it? Yes, I buy it every day. How about this company? Boy, did we get pushed back on this company. You're investing in Procter & Gamble? That company's never going anyplace. No, maybe not. They've been raising dividends for 64 consecutive years. They've had increased revenues, increased earnings for 64 consecutive years, but they're not going anyplace. Earnings rose 28% to $3.19 billion in the second quarter, ended December 31st. $125 a share, exceeding the $121 consensus. Net sales were $17.44 billion. Full year forecast for organic sales growth, 2 to 4%. No, they're not going anyplace. Here's some other companies I like a lot. Hasbro, Smuckers, AbbVie, AT&T, and Verizon. AT&T and Verizon? Have you looked at AT&T's share price lately? Yeah, and they pay 6.5% dividend yield. And between those 2 companies, Verizon and AT&T, they have 94% of the wireless market in the United States. Wait a second. Yeah, Verizon and AT&T. They have a little problem, each of them? Yes. Especially because AT&T bought Time Warner. They went to court, they won, and the government appealed it, the Justice Department appealed it. Anybody want to know why they appealed it? Because Time Warner owns CNN. And you can take it from there. Epilogue. You need help? Email me. You put seminar in the subject line, or you may not get an answer. There's my email address, lauren.rudd@ruddinternational.com, not too difficult. RuddInternational.com happens to be the website. All this stuff is on there and a lot more. Help yourself. Time out for small commercial. We support Southeastern Guide Dogs. Now, last year we had a puppy on parade. We asked for donations, and it's $1 per vote, and we won. We raised over $13,000 for Southeastern Guide Dogs. We actually have one of their dogs. It didn't pass the physical, so they gave it to us. We use it as an ambassador dog. But it's a great organization. This is our current entry, Beacon. If you go to that website, you can donate. There should be a lady out front here. We'll also accept your donations. All the money goes to, we don't touch it, it goes to Southeastern Guide Dogs. We're asking you to please donate. We want to keep Beacon in first place. We'd like to have a second trophy that protects the first one. It's a little glass trophy worth about $1.98, but we keep it in a prominent place in our office. So there's Beacon, another view of him. That thing that he's holding is a railroad lamp that actually works. We use a battery now, but there's last year's entry. There's Beacon again. So stick with a bullish strategy. There's our disclosure statement. There's our building. Now, this is very important. I want you to watch this. We're moving downtown. 1950 Ringling Boulevard. We liked our space, but we don't own it. We don't own the new space either, but we own a piece of it. So we are moving into the Sable Palm Bank Building, the newest office building in downtown Sarasota. We expect to be there around June. Don't come over there now. Look at my office. It's a big empty hole. They're putting the construction in. The building, of course, built. Sable Palm is in there, and Gilbane, a big international builder, is in there. But we have the bulk of the fourth floor. Bank has 2 floors. Gilbane has 1. He got the 3rd. And we have 5,000 out of 7,000 square feet on the 4th floor. And those windows you see right here, right there, that's my office. It really is. All right, that's the editor. You all seen him in previous things. People said, does he really exist? Yeah, there's a current picture of him. And he's still doing the same thing he was doing before.